Hi, I'm David Buckland from Montgomery Investment Management. Share markets have seen a lot of volatility in recent weeks. This has stemmed from the US Federal Reserve announcing the progressive tapering of their support for quantitative easing. After spending $85 billion per month for the last few years supporting US bonds, the US Federal Reserve has cut this to $75 billion per month, and now under Janet Yellen's watch to a proposed $65 billion per month. Quantitative easing has been working in the US, with house prices up 13% year on year and housing starts heading back towards a more normal 1.4 million level. Unemployment has declined from 10% to 7% and the US budget deficit is forecast to head down to 4%. The unintended consequences of the threat of tapering has seen severe decline in the currencies of many emerging markets. Much like the Swiss loans in Australia in the mid-1980s, an aggressive decline in the home currency can have devastating consequences on the principal owned on the foreign currency. Around 1 year ago, the top 20 emerging economies by gross external debt to GDP ratio averaged a combined 74%. I believe that figure is now closer to 85%. The second problem is that many of these emerging markets have, on average, 1/4 of that external debt maturing anytime soon. Foreign lenders of these emerging economies, particularly the European banks, want to be rewarded with much higher interest rates, or they just repatriate their funds. Turkey, for example, has to come up with $200 billion on their gross external debt, and that is about 1/4 of their GDP. Obviously, solvency issues for places like Turkey and many other Eastern European economies if the banks don't play ball. It's no surprise then that last week we saw places like Turkey, Brazil and South Africa try to defend their currency by aggressively lifting their short-term interest rates. And higher short-term interest rates will lead to subpar growth. So the unintended consequences from tapering by the Federal Reserve has commenced in various emerging economies: falling currency, higher gross external debt and higher short-term interest rates. This has led to increased market volatility. At Montgomery, we are looking for share prices of selected high-quality businesses with good prospects to come back to slightly more compelling levels. We're holding a lot of cash in both the Montgomery Private Fund and the Montgomery Fund in readiness. That's all from me this week. In the meantime, you can follow us on Facebook and Twitter.